Welcome to Nerdbull1669 Weekly Trading Outlook tips, right, for this week, 23rd to 27th of March 2026. So before we move to this week, right, so the week of March 16 to 20th of 2026, right, was actually defined by a heavy risk-off sentiment as the intersection of a geopolitical conflict and a hawkish Federal Reserve pushed the market into their fourth consecutive week of declines. So for the market summary of 16 to 20th of March 2026, right, the major indices actually ended the week significantly lower as investors grapple with the soaring energy prices and a central bank that signal a higher for longer stand on interest rates. So on the index performance, S&P 500 was down 1.6% weekly with Friday close at 6,507.49. So for the Nasdaq Composite, it actually closed down 1.98% lower at 21,653.71 as of last Friday, 20th of March. So Dow Jones was also down by 0.96% weekly with a Friday close at 45,577.46. So the key market driver, okay, for last week was actually the FOMC hawkish hold on 18th of March. So the Federal Reserve actually kept the interest rate steady at 3.5% to 3.75%. However, Chair Jerome Powell actually raised the 2026 inflation forecast of 2.7% to 2.7%, actually was up from 2.4% previously. This is due to the energy prices spikes. Okay, so but the dot plot now suggests, right, only one rate cut for the remainder of 2026, causing a sharp sell-off in the growth and the tech sector. So on the energy and the geopolitical title, so but crude will actually surge above the $100 per barrel for the first time since 2022. So report of an extensive damage, right, to the liquefied natural gas, the LNG, right, infrastructure in Qatar, and the effective closure of the Strait of Hormuz, right, actually hit Asian and the European market particularly hard. So Nvidia GTC 2026, which happened on 16 to 19 of March. So despite the macro gloom, right, Nvidia provided a midweek spark. CEO Jensen Huang actually unveiled the new Vera Rubin architecture and projected a 1 trillion in AI-related revenue through 2027. While this led to a temporary 1.6% bounce in Nvidia, the broader market downward momentum eventually pulled the semiconductor sector lower by last Friday, 20th of March. So flight to safety. So the US dollar index, the DXY, actually climbed back above 100, and the VIX spiked 20% to end the week near 25.87, sorry, reflecting deep-seated investor anxiety. So now coming to the market outlook for this week. Okay, 23rd of March to 27th of March. So the upcoming week is actually expected, right, to be dominated, right, by defensive positioning as the market attempt to find a war floor. So the first so-called title will be shift to defensive and value sector. So do expect a continued rotation out of the high beta tech and into safe haven sector. So investors are actually prioritizing balance sheet strength and dividend reliability. So sector like aerospace and defense sustain interest in Lockheed Martin and the Northrop Grumman as the global defense spending is repriced. So for energy, the upstream side, companies with the non-Gulf asset or high exposure to the North American production are likely to outperform as the supply gap widen. So on the consumer, staples and healthcare, this is another sector to look at. So stocks like Walmart, United Health, and PepsiCo, right, are being used as a parking spot for capital. So, okay, the next title will be the high volatility and the technical level. So the S&P 500 is actually testing a critical support levels after a 4-week slide. So if the index fail to hold the 6,500 point level, right, the technical analysis, a technical analyst, right, actually warns of a potential slide towards the 200-day moving average. So on the war premium, so expect a headline risk to remain high. So any news regarding a ceasefire or conversely an escalation into energy producing region like Saudi Arabia, Eastern Province will cause a plus minus the 2% swings in the intraday trading. And then on the impact of the rising yield, okay, so the 10-year yield, treasury yield is actually drifted towards 4.3%. So if yields continue to climb on inflation fears, so the valuation reset for software and AI growth company, right, may intensify, even for companies with the strong fundamentals like Microsoft and Alphabet, Google. So, okay, the next one to watch will be the macro data to watch. Okay, consumer sentiment. Okay, so important early March data, okay, will show how much the spike in gasoline prices is actually hurting the American consumer. And also for the durable goods order, a key metric for gauging if corporations are actually pulling back on their capex due to the political uncertainty. So appreciate if you could share your thoughts in the comment section on this video, and do help to like and share this video. We greatly appreciate your help. Under this disclaimer, the analysis and the result presented, right, does not recommend or suggest any investing in the stock. Okay, this is purely for analysis purpose. Appreciate if you can like and share this video if you find this video useful and helpful for you. Thank you for your support, and we look forward to you supporting the channel for more content. Now moving to the macro snapshot context only. So the combination of the March 18 Federal Reserve hawkish pause, right, and the escalation kinetics conflict in the Middle East, specifically the blockage of the Strait of Hormuz, has fundamentally repriced risk, right, across all asset classes. So on the risk appetite, we're looking at aggressive or de-risking. Okay, so the risk appetite has moved from a move into a outright cautious, bordering on the tactical panic in some pockets. So institutional behavior, we are seeing a migration to liquidity. Institutional traders are no longer buying the dip in the high growth tech. Instead, they are rotating into defensive hedges like energy, aerospace, and consumer staples. Okay, safe haven demand. So the US dollar, the DXY, has actually surged back above the 100 level, and gold has also seen extreme volatility, briefly touching the 5,000 per ounce before correcting. So signaling that the investor are prioritizing capital preservation over capital appreciation. So on the rates direction, okay, we're looking at higher for even longer. So the interest rate outlook has turned significantly more restrictive as energy-driven inflation risks mounted. So the Fed's stand, right, the FOMC capped the rate at 3.5 to 3.75% on March 18, but the dot plot shifted. So the Fed now projects, right, only one rate cut for the entirety of 2026, down from a previous expectation of 2 to 3 cuts. So for on the yield curve, right, the 10-year treasury yields, right, has actually climbed towards the 4.3% as the market prices, right, in a surge in the PCE inflation, now forecasted at 2.7% for 2026. So traders has actually effectively priced out any chances of a rate cut before mid 2027. So on the global context, right? So both the Bank of England and the RBA has also adopted the hawkish tilts, signaling that the global easing cycle, right, actually hit a geopolitical war. Okay. On the volatility regime, looking at high stress, fear index spike. So the market has actually entered a high volatility regime, moving away from the low volatility environment of the early 2025. So the VIX level, the VIX, which is regarded as a fear gauge, right, actually surged past the critical 25 level, ending the week near 25.80. So this level historically indicate that the market, right, is actually pricing in daily swing of nearly 1.7% for the S&P 500. So the regime characteristic, this is the 88 per percentile of the market anxiety over the last decade. It is categorized as a extremely nervous, comparable to the initial weeks of the 2022 Ukraine invasion. On the commodity volatility, so Brent crude, right, is actually stuck at an exceptionally wide range, $99.50 all the way to the $119.10. So making every headline regarding the Strait of Hormuz, right, a potential plus minus 5% mover for the energy sector. So coming to the weekly outlook for S&P 500, SPX basically. So basically for the weekly trend and the pullback risk. So the S&P 500 is currently attempting to build a wall floor after 4 weeks of selling. So for the trend continuation, right, to re-establish the bullish trend, the index must actually reclaim the 6,731 to 6,782 resistance zone. So a daily close above the 6,782 level, right, will act as the green light for a recovery towards previous highs. So on the pullback risk, right, the immediate risk is a failure to hold the 6,500 level. So a break below this 6,500 level, right, likely to trigger a major move lower towards the 200-day moving average as defensive rotation intensify. So coming to the weekly outlook for Nasdaq. Okay, so we're looking at the strength and then the failure level. So Nasdaq, the technical structures for the tech-heavy index has become fragmented due to the high interest rates. So we are looking at the strength above 25,173 points. This level aligns with the 50-day period SMA and a major downward trend line. So reclaiming this level, right, will actually invalidates the current bearish structure and suggests a return to a dominant bullish bias. So for failure below 24,092 points, right, this is the critical support at the 200 period SMA, and then a sustained move below this level will actually activates a deeper bearish bias. So potentially targeting the 22,300 zone, which is looking at a 5 to 10% correction range. So now coming to the weekly level for CrowdStrike, CRWD. So CrowdStrike is actually consolidating after a blockbuster Q4 report. So reclaiming the $430 level will signal a move right towards the $540 intrinsic value target. So our bullish bias, right, we're actually looking at above $430. So invalidation stop level would be below $415. So for CRWD, right, watch the Falcon Flex adoption rate. The stock is a high beta play that will suffer if the Nasdaq actually break its failure level. So coming to the weekly levels for ExxonMobil XOM, so we're actually looking at the coil beneath the major gamma wall at $120. So a breakout here we actually target the $124 to $128 level on the energy supply fears. So for our bullish bias, right, we're looking at above $120 level, and then the invalidation stop level, right, would be below $117.20. So for SOM, effectively a hedge against the Middle East escalation. Bullish bias remain intact as long as the oil hold above the $95 per barrel. Okay, now coming to the weekly levels for FedEx, FDX. So it's actually trading higher post Q3 earnings last week with an earnings beat. So you actually need to hold the $372 level, expected move ceiling to confirm a new leg up. So for our bullish buyers, right, we're actually looking at the above $372. So the invalidation stop level, right, will be below the $348 level. So for FDX, beating the estimates actually provide a valuation cushion, but do watch for the war-related fuel surcharges impacting the future margins for FedEx. Now coming to the weekly levels for CCL Carnival. So it's actually testing the middle Bollinger band. Okay, so a break above the $25 right will signal recovery. So anything that's below the $23.30 will suggest a trend shift towards a bearish. So our bullish buyers will be looking at above $25, and for the invalidation, the stop level, right, we're looking at below $23.30. So CCL is actually extremely sensitive to the consumer sentiments and the fuel cost. So it's currently viewed as a high risk recovery play, especially when we is going to have the earnings on the 27th of March on Friday. So a bit of the risk management framework. So these are the three things that we should always keep in mind. So trade levels are not the opinion, and we should define the invalidation before we entry, and then also reduce size during the consolidation. Do practice discipline and patience with. So this video is actually for educational content only, and it's not financial advice. So the disclaimer, so the analysis and the result right, actually presented does not recommend or suggest any investings in the state stock. So this is purely for analysis purposes.